Nikkei report that TSMC is indeed going to start raising prices by about 10%, a strategic move heading into 2027. To talk a little bit more about the chip trade as well as the broader earnings season is Matt Orton, Head of Advisory Solutions and Market Strategy at Raymond James. And he joins us here in New York. Great to see you.
It's great to join you, Romain.
Let's talk about the chip trade. And we talk about the gains that have already sort of been booked on this. Gains that I think most people would say have been justified by revenue growth, justified by margins and EPS. We're heading now into another earnings cycle where not only will we want to hear what happened over the last 3 months, but whether those CEOs and CFOs are going to be as bullish about the months going forward. Are you optimistic?
I am optimistic, and I fully agree. I think what investors want to hear is that not only are the hyperscalers continuing to make investments and increase their CAPEX numbers, we're going to get the first look at that tomorrow after the bell with Alphabet, and then it's really, are we still seeing the revenue and earnings acceleration taking place at a lot of these semiconductor companies that you would need to justify a lot of their share price moves? So far, I would say the parabolic moves are justified by parabolic increases in earnings growth, so we have to see that sustained, and I think we're going to see that given what we've already heard from ASML, what we've heard from TSMC during earnings, and what they've just reaffirmed with their pricing power.
But does this become one of those situations where what benefits the chip makers ends up hurting some of the other companies? Because every time I hear about price increases, that's great if you're the one selling and making those price increases, but if you're the taker of that on the other end, or is that the wrong way to look at it, particularly when it comes to the larger customers?
I think the larger customers are a little bit price insensitive at this point because they still have free cash flow that they can put into this. The capital markets are open to them in order to continue to finance what they have to do to build. And when you look at the backlogs that we heard last quarter and through a lot of channel checks that we've done over the past few months, what you've heard from a lot of CEOs of these hyperscalers is that they have $2 trillion backlogs for their cloud businesses. So spending $1 trillion to get $2 trillion in real tangible revenues that are legally binding in most cases, that seems like money well spent.
So it sounds like you remain confident in that story at a time when there's a lot of questions being raised. We had a great chart that we were showing yesterday that you look at 12-month forward cash flow estimates for hyperscalers versus semiconductors, and it's a flip-flop in favor of the semiconductors. And when it comes to the capital markets, I mean, you think about some of the receptions in the primary debt markets to some of these big deals. They're starting to cool a little bit. We're talking about oversubscriptions, but maybe less than we would have seen in the previous 6 months or a year ago period. But it sounds like what you're saying is that you still remain pretty confident in that story.
I remain confident, Katie, but it's all about execution, right? So earnings season is a great time to make sure that these companies are on track. Those who are spending, are they monetizing in their cloud businesses? Are we seeing the RPO, their performance obligations continuing to grow, which means there's still a backlog for where they're investing all of that free cash flow? And I think the market pushing back a little bit on the massive amount of issuance that we've seen both from debt, equity, I think that's healthy just to say, like, you have to show some sort of return or a path towards that. And the more successful companies, I think, will. And that's what I expect to see tomorrow, starting with Alphabet.
And Matt, I'd love to get your perspective on this broadening out trade because, you know, we've been mentioning it. You think about what we're seeing in value. That's outperforming. Small caps outperforming. And it's kind of curious and unintuitive given how much time we spend talking about big tech and what's going on with the AI trade. But when it comes to that broadening out, do you think that there's still room to run when it comes to those areas of the market?
I think there's room to run, Katie, but I think you have to be specific about where you're looking for investment. So the earnings breadth story has been here for a while. We've had earnings breadth across S&P 500 sectors for well over a year at this point. And what's encouraging is that we're seeing other sectors, financials primarily, who have already been reporting, we're seeing that earnings momentum continue to the upside, and that's finally being rewarded with respect to share prices. So I think there's more room to run in financials. Other sectors have to deliver that growth. But then the question is, valuations aren't necessarily attractive across all of those spaces. So
I do want to get your thoughts on what's been happening in the pharmaceutical space. I mean, basically, at least when you look at the main indexes, whether it's NASDAQ Biotech, S&P Pharmaceuticals,